In this moving average trading strategy video, we are going to discuss why we've developed our own moving average, as well as how we've paired the moving average to a very specific set of entry rules, which has turned our moving average pullback setup into one of our most consistent, high probability trading strategies to date. By the end of this video, you will have all of the tools necessary to trade this setup consistently and profitably on your own. The 20 period and the 50 period moving averages are probably some of the most widely used averages. If you have no idea where to start with moving averages, I can almost guarantee you that the 20 or 50 period moving average will fall right into place in your trading. We even use a modified version of the 20 and 50 that we've created for our own trading, which will be discussed further in part 2 of this series. We will be using the 20 and 50 period exponential moving averages as a zone. And this will show us not only when price is pulling away from the averages, but also a general location of where to expect price to pull back to once the current leg up is ready to take a breather. We need to identify exactly where price is going to pull back to in order for us to have a high probability entry point. The way that we will define this entry level is through key trading levels, a form of support and resistance that have more strength, more significance, and more reliability than traditional support and resistance. The second lesson of this series is focused on stacking key levels with the moving average zone that we discussed earlier, to more precisely locate the where of where a trade is most likely to take place. The first thing to consider is that key trading levels are not just simple support and resistance levels. The way that we are going to locate key trading levels is by zooming out of the smaller picture that we are currently looking at and taking a look at the bigger picture inside of a larger time frame. For example, if we are doing our analysis and looking to take trades off of the 1 hour time frame, what we do is zoom out to get a bigger picture of what price is doing. We will look at the daily or even weekly time frame levels of support and resistance. This way, we are using more established, well-respected levels which hold more weight and are therefore more reliable levels to take trades off of. Once you start plotting your key levels like this, you are going to see a dramatic increase in the reliability of your support and resistance levels. Once we zoom back into the original time frame, we will be able to see key trading levels which provide us with more consistent trades and more accurate trade entries, while also eliminating the majority of noise that standard support and resistance would have created. Here's a pro tip. The longer the time frame, typically the easier it will be to trade. For example, while the daily time frame would be one of the simpler time frames to trade from, the 1 minute time frame will be one of the most difficult to trade from. Intraday trading is much more difficult than swing trading the 4 hour and daily time frames. If you are struggling to bring in consistent profits, try to work off of the longer time frames like the daily. Dial back your position size and take less risky, smaller positions that play out over a longer period of time. Not only is a daily chart more reliable to trade off of, but the smaller size and slower trades will allow you to manage real money trades at a more comfortable pace, while reducing the stress of being heavily leveraged. This will also help you to build the confidence that you will need when you return to trading bigger positions on the shorter time frames. We have identified a high probability trade setup when the price pulls back to the moving average, if and only if a key trading level is also present at or near that price. Price does not have to hit the moving average, however, it does have to hit the key level. While the moving average is also present at this price, the key level is the more important signal. Part 2 of this series will go more in depth on our moving average as well as our complete entry strategy. While adding these two levels together will give us some fairly consistent winning trades, we will get significantly more consistent trades when we know exactly when a trade presents itself. Where a trade is taking place is covered with the key trading level. Understanding when a trade is taking place is the result of a good entry strategy. This also allows you to be confident in the trades that you enter. Essentially, it tells us that the price is moving now, giving us the green light to take the trade now. If you are interested in watching part 2 and learning more about our entry strategy, as well as our moving average, please feel free to do so through the link below in the description. Please don't forget to like and subscribe if you learned something new. Also, don't forget to save this video in your trading folder so that you can revisit us in the future. An occasional refresher on this material will only help to solidify these concepts further. I wish you the best of luck in your trading. Always remember to trade safe, trade smart, and trade profitably. Thanks for watching,